Welcome to IBM Developer Tech Talks. I'm your host, Calvin Powers, and I've been looking forward to this week's Tech Talk for a very long time. This is called Get Up to Speed on Fundamentals of FinTech Concepts, and it's the first in what we hope to be an ongoing series to introduce software developers to this wonderful world of FinTech and some of the specialized computing that goes on in that arena. Our guest today is Rob Seidman, and he's what you call a quant. And I never knew what a quant is. I heard people tell themselves, or tell people they were a quant, and I had no idea what that was. It turns out a quant is a person who is an engineer type person in the financial services and financial analysis sector. So I thought that was real interesting, and we're going to get Rob to tell you all about that in just a second. But first, I got to do a little bit of housekeeping before we get started. Now, if you're watching on the IBM.com event page and you would like to ask a question of Rob or some of our subject matter experts, click that link on the side of the video that says join the chat. That will take you to the YouTube page, and then you can type in your questions in the chat widget of that YouTube page. We've got some subject matter experts who are monitoring that chat who will try to answer your questions. And if they can't answer your question, then they will route it to Rob and I, and we'll try to answer your questions on the Tech Talk. Also, if you're already on the YouTube page, I would encourage you to look at the description field and follow the first link in the description field back to the event page, because that will have a bunch of getting started links and other resources that help you get started with some of the things we're talking about today. So with all that housekeeping behind us, I want to hand it over to Rob Seidman, who'll tell us more about this wonderful world of financial engineering. Rob, take it away.
Thanks, Calvin. So let me just take a minute to introduce myself. My name, as Calvin says, Rob Seidman, and I'm an offering manager for a solution that we're calling the IBM Financial Risk APIs. So some of you might have caught a former tech talk that I gave where I talked at a high level at some of the mathematics underpinning these use cases, and we want to dive down a little bit deeper into some of this. Should mention, as Calvin pointed out, we have Kirby Kim, who's our eyes in the sky, our senior developer, who will be answering your filtering questions through the chat. So if you have anything, feel free to interrupt. I would love to make this a little bit more informal and not like a formal kind of, dry presentation. So, let me go back to the motivation of why we're doing this. We are releasing quite a number of APIs that are very dense in subject matter when it comes to financial services. So our mission is to simplify the use case of those APIs and of those workflows, processes, to enable a wider audience to be able to play with them, to build things on top of them, what we refer to often as democratizing access to these capabilities. So as we've gone down this road, both internally and externally, we found a lot of enthusiasm to use some of these components. But one of the pieces of feedback that we hear most often is, I know, the how to work with these tools, but, what's often missing is the what or the why. So that is the motivation of this and hopefully a number of future talks. I should point out that, as I'm talking about this, I'm going to be talking at like a 10,000 foot level. So I'm trying to simplify things to more of an explain like I'm five kind of approach. But in doing so, I might gloss over some very important technical things that might, cause some inaccuracies. So if somebody, hears something and wants to, point something out, please feel free to. I'm happy to clarify. I'm trying to just keep the level high so we can breeze through the material as quickly as possible. So, that being said, let's start at the very beginning, and I can share my screen. Okay, so assuming everyone can see this, we're like to unofficially call these brief presentations FinTech from the Forest, as you can see this lovely backdrop behind.
Hey, Rob.
Yes?
There's a little overlay that says hide. Click that hide button to hide the overlay. There you go. Now you're good.
All right, so this is actually a picture of what you guys are seeing behind me. I'm in New Jersey in what's known as the Sourland Mountain region, one of the last great forests, outside of New York City. So this particular talk, where we'd like to cover financial securities. What are things you can invest in, and what does that even mean? And with any luck, we will start to touch on topics of time value of money and leave some of the other activities for future talks. So let's start with that. What is a financial security? What does it mean to invest in something? And more importantly, what kinds of securities are there? How many can you name? Just think for yourself. We'll leave this as a sort of exercise left to the reader. So let's start with the absolute basics. First, we need a hypothetical company. I typically will use, XYZ. So let's use XYZ, our mid-sized purveyor of early childhood education toys based in Toronto. So this is a new up-and-coming company. It's publicly traded and purely hypothetical, I should point out. So like any company, there's going to be a balance sheet, the statement of all of the debts and assets and equity that a company has. So let's take a step back. You have money, you have some funds, and you would like to make those funds grow. You might have heard, putting your money to work. So fundamentally, what the capital markets, or the arenas in which you can buy, sell, trade securities, is meant for, is to really take funds that savers, a person who has excess funds and not a lot to do with it. If you could make money on your money, you can go build widgets and sell them for a markup or provide a consultative service. Then that's great. But for those who don't necessarily have any immediate ideas, or have day jobs and have time doing other things, you need to sort of find a way to put that money to better use. And so companies might have, needs to, if they could take your money, they could put it to use. They could build widgets, they could perform services, or whatever it is that they do. They could sell, make and distribute early childhood education toys. But if you're a company, how do I give XYZ my money? Like, if I want them to take my money and give me some kind of return for it based on the risk that they may not deliver what they say they're going to, how do I do that? And so very fundamentally, there's kind of a few ways, and this balance sheet really reflects that. So this is, again, a gross oversimplification, but you can start with the liabilities or the debt. So in that case, I could give a company, I can give XYZ my money, and they could pay me back over time. It's a loan in some cases, or a bond, which is just a more formal, structured version of a loan. So they could borrow that. There could be very strict terms around what it looks like to pay me back, on dates, on when they're going to, how much they're going to pay me. And then you can get all types of complicated as in terms of, they're known as covenants, which are the provisions included in a fixed income security. Fixed income meaning that things are decided kind of ahead of time. Roughly what the payments are going to be and when they're going to be. So let's take the simplest example, which is like a government bond. The federal government of the United States, of Canada, of any major country, is much like a country in that respect, that they need to finance their operations or their growth. They need to borrow money, put it to work, and then promise people, or whoever gave them said money in return. The covenants might govern things like, well, what's the coupon rate? You could have just a lump sum payback, which is sometimes referred to as a zero coupon bond, where I give you a bunch of money, and at some point in the future, you give me all of it back, presumably with some interest, which is the reason I gave it to you in the first place, to earn that, $1, $2, $3 on $100 loan. More commonly, when you get to the fixed income markets, you'll see, bonds with coupon rates that pay, say, quarterly or semi-annually, in which case you're going to get a payment every 3 months, every 6 months, regularly for the life of the security. Then things can get real complicated. You could have floating rate notes in which that payment is not fixed. It's not going to be hypothetically 3% every year. Maybe it's, well, whatever the U.S. government 10-year rate is plus an additional 1%. It could be a convertible bond, which means at some point you can exchange it not for money, but for equity of the underlying company, which will have value in some cases and might be a little less worthwhile in others. So a mortgage is a good example of this kind of security. In which case it's kind of flipped. You're the borrower. You need money to buy presumably a home, and then you pay it back monthly, quarterly, whatever your deal is with the person who lent you that money, until it's all paid off, and there's interest in that, which is why they lent it to you in the first place. So there's a whole established, this is one of the largest sets of markets in the world, is the debt markets, the fixed income markets, the capital financing. So moving on to the right side of the balance sheet, that's the liability side. That's usually the sort of negative column. That's what the company owes to various parties. And one thing, actually, before moving on, I realized I wrote this here. When you're looking at the debt structure of a given company, there is a sense of hierarchy or prioritization, that some bonds are, or some of these loans are deemed, higher priority. They're higher lien. They get paid back first. So if things go wrong, which we'll cover in a few slides, it's sort of a top down from the balance. The most senior, as it's referred to, debt gets paid back first, as the company's liquidating or trying to pay back all of its outstanding commitments. And then people lower on the totem pole, so to speak, get paid back after, if there's enough to go around, which is why the interest rates tend to be a little bit higher on those securities. If there's more of a risk that you don't get paid back, then you need more of a reward for taking on such risk. So this next section, I have the asset side, and this is sort of the positive column of our hypothetical company. These are the things that it owns, and if you're dealing with sort of a pro forma valuation of companies here, this is going to be more like the cash flow streams that a company would make over time for selling its products. But we've grossly oversimplified this to say these are the things that this company owns. And the reason I say this is a misnomer is because you don't really invest in like the individual assets on a company's balance sheet. That's not how it works. I'm just kind of using this as an example to show one other common type of asset to invest in are real assets, or things that have tangible or quasi-tangible value in the real world. So a good example of that is currency. We've selected this XYZ company to operate out of Toronto. So therefore, potentially they have holdings of US dollars because they operate in Canadian dollars, but they do a lot of business in the US, and so that would show up. And FX, or foreign exchange, is a great example of a type of investment one could make. Unless your currency is explicitly pegged to another currency, then they will float and change value over time. And there's all sorts of financial engineering rules to govern how that works. Ways that it's called no arbitrage conditions. So you can't game the system by buying an infinite amount of one thing and selling it for infinite profit, that balance out with supply and demand pressures, and it's all tied into interest rates, and it's a subject for another talk. Another type of real asset might be commodities. So they could be as simple as, holdings in gold or some other precious metal. They might be agricultural goods like, cotton or other forms of textiles, or farm goods like soybeans and corn. And finally, there's real estate. And so real estate could be, you can classify it in a number of ways. Different types of real estate tends to have different types of market participants that care about different things. So residential real estate, commercial real estate, in this case, maybe the office building isn't leased, it's owned by the company. Industrial securities, things like, so one of the things I forgot to mention earlier, throughout my career, I've actually worked on quite a large number of implementations, specifically in the hedge fund space. So throughout the talk, I'll kind of mention some of the crazier stuff I've seen over time, and then we'll have some sort of poll to vote on which story we want to tell in our next session. So, when it comes to that, I've seen things like airplane hangars and timberland fields as actual assets on a company's books that they own with the expectation to, increase in value over time. And I don't want to dwell on this too much, but, the cryptocurrencies are tend to be pretty popular these days. You can lump those in it's kind of up in the air whether they're more like currencies or more like commodities, depending on the type and how you think of it. So if you were to put them anywhere, you put them in here. So then finally, what you hear about most when you're thinking about your investments, if you're a U.S. citizen, your 401k, your retirement fund, you normally think about equities and the stock market. And so what is equity? Equity, the fundamental like accounting theorem says that the equity is kind of the ownership of the net value of the company. So it's the upsides, everything left over after all those negatives in the liability column are accounted for. That's why stocks are a little bit more risky, because they, if in our previous example, when you liquidate everything, if there's no more money to go around, equities usually last on the totem pole to get paid back. And so, it can almost be considered like a call option, or we'll talk about that later on, the company's future earnings. And so that equity, there's a number of different kinds. You can have preferred shares, which usually come about in a company's inception, or when special things are structured, and those are usually not as liquid. They're not traded as often, but preferred shares will act a little bit more like bonds, and they'll have a particular specific payout that's well defined. Common stock is this kind of stock that you and I and people like us can interact with on the market through exchanges like New York Stock Exchange and NASDAQ and et cetera. And then one other caveat, or one other type I would point out, is something known as depository receipts, or in this case ADRs, which stands for American Depository Receipt. And all that is a security that is listed in a country other than its home country. So in our hypothetical, XYZ is a Canadian company. If you wanted to buy that, in my example, in the New York Stock Exchange, you would be buying what's known as an ADR, which is sort of like a cross listing for that Canadian currency denominated in the dollars. Like, so you don't have to go and buy Canadian dollars in order to invest in this particular security. So those are kind of between equities, assets, and liabilities are the foundation for a lot of pretty much all of the capital market space. So before I move on, Kirby, Calvin, have there been any questions in the chat?
Not yet, there hasn't, but this is a very good starting point, and I will be interested in hearing you talk about some of the different types of equities and assets that might fall into play here.
Okay, so those are like the real assets, and their price tends to be governed by supply and demand pressures. Where things get interesting are the different types of financial engineering layers you can put on top of it. Those are often known as derivatives. So a derivative, it's a mathematical term, but in finance, we think of it as anything that derives its value based on something else. So this is where you start to get into the world of, you can call it betting, but in general, it's usually used by institutions for hedging. Hedging and betting are really in the eye of the beholder, right? As to whether you're trying to protect yourself against losses for a particular thing, or you're trying to capitalize on said losses, or you can flip it around and protect against or try to capture gains or etc. So it depends on who you are and really what you're allowed to do, because once we get into this space, some of these investments are going to be off limits to some of the more conservative financial institutions. They can't hold a tremendous amount of risk, and this is something that became evident and present during the 2008 financial crisis, where certain financial institutions were allowed to hold one side of the trade, for example, to benefit or lose based on the outcome of one of these bets or hedges. But that kind of exposure, it has been deemed a little bit risky. So really what I want to do for the next 15, 20 minutes is go over the different flavors of betting on things or hedging. And I want to point out that these paradigms can be applied to all of the various asset classes. So this kind of becomes augmentative, where you can have different types of bets on those equities, on those assets, or on that debt, that fixed income. So let's start with futures and forwards. So this all started several hundred years ago actually. And you can think the use case that comes to mind for me is, the farmer. So the farmer, when you're doing these derivative transactions, you're introducing a time element into it. You're trying to, in the first example, protect against future price movements, whether it's up or down. It depends on what side of the trade you're on. So a forward contract is sort of the simplest example. And so in each of these slides, and I'll make these slides available after this presentation. So the case in forward contract, it's what's known as an OTC, or over-the-counter security. And in finance, OTC security means it's not traded on an exchange. It means it's usually custom. Sometimes they're similar. You can carbon copy a deal that you like and change the parameters, but it's not something that's readily liquid that you can easily pawn off on someone else if you want to get out of it. It's a very custom deal to your use case, is usually what the term stands for. The opposite of OTC is exchange traded, and we'll look at a few types of those. So forwards are OTC, which means they're custom contracts. And let's go back to our farmer standing in the field wondering about this impending storm coming to North Carolina, for example. They might be wondering, I don't know if this is going to hurt me. It's going to miss my field, hit the next field. But I spent a lot of time and money fostering my crop. And you know what? I would just sleep better at night if I could lock in the price now that I'm going to sell it at. So I don't have to, worry that there's going to be a glut and I'm not going to get as much money as I thought, or, at the same time, I'm going to trade my upside by locking it in now. Things could move in my favor, but I'm going to say that's okay. I want to know what it is. So a forward contract actually started in sort of, I believe, in the commodities market. And so using this agricultural example, so maybe the farmer wants to say, okay, 1 year from now, or 6 months from now, let's say we're in March in the spring. 6 months from now, I'm going to sell you 100 bushels of cotton's bushels for X dollars. And we'll shake hands, and that's the deal. And as long as the person delivers on what they say, they get the money that they were promised. You can see on the bottom right here, I've got some payoff diagrams. And that's, if you think about the x-axis being the price at maturity and the y-axis being your payoff, obviously, if you're long a forward, the higher the price in the future, the better off you are, right? So it's pretty nice straight line payoff diagram, nothing crazy.
Rob, I don't quite understand that. So the payoff amount, if it's nearer in the future, it's lower, and if it's further in the future, it's higher.
Right. So let's use an example.
But a contract's usually for a specific time, right?
Right. So that price at maturity, that maturity is the specified time in which we're going to complete this trade, right?
Okay.
So that's known. We decide, let's say it's 6 months from now. And we'll see in the next slide that when we go to the more standardized markets, that becomes more standardized. But in this example, I've got 100 bushels of cotton or 100 bushels of corn, and I want to sell that. I'm going to sell it to you for $100 a bushel 6 months from now. If that price goes down, then I've won. I'm going to get more than that corn would have ordinarily be worth had we not made this deal ahead of time and waited till that maturity date and then tried to sell it to you. If it's trading at $50 a bushel, I lost out on the opportunity cost of an extra $50. I could have gotten 100% more. So I would be pretty upset. But I'm sitting pretty if I sell the two for $100 and it falls to 50. Obviously, the person on the other side who's buying it has the opposite payoff diagram. So, for example, if I agreed to buy it at 100, price skyrockets to 200, then I get to buy a bushel for literally half the price. It's like a 50% discount because I made this deal ahead of time. But if it falls, then I'm paying twice as much, or some multiple or some percentage more than I could have had I just gone and bought it in the open market, because I structured this deal. So it's, again, the direction and magnitude is really in the eye of the beholder, what side of the trade they're on. But the idea is that it's a zero-sum game. There's going to be a winner and a loser if you strike it at a price, if that price goes up or down. So moving on to the next example, we can talk about futures contracts. So futures contracts are, for all intents and purposes, very analogous and similar to forward contracts. They're just standardized. So because they're standardized, they can be exchange traded, because I know that one futures contract, which is usually for some multiple of an underlying good, be it a commodity or something else. They all look and sound the same, right? And so therefore, I can exchange it to someone else and they know what they're buying. And that's really what the job of the exchange is. It's not just to match buyers and sellers together, it's to enforce that standardization, to define what it means to be a standard contract. So, in our example, maybe that 100 bushels of cotton is the standard, right? So the contract is for 100 bushels. It ends on six months from now on the 21st of the month, and it can move in denominations of 10 cents or $1 increments. And so the payoff is going to be the same because it's really the exact same type of contract, the same kind of deal you're making. But instead, it's just more standardized. And so therefore, if you don't like it a month in, you could sell it to someone else. And that contract might have a different value a month in. If we're in a world where the price of the underlying has doubled, then it's either going to be much more expensive or cheap, depending on which way it moved, to buy that exchange traded future. So as an example, I love going back to the movie Trading Places. If anyone's seen that with Eddie Murphy, Dan Aykroyd, where they're basically playing the futures market at the end of that movie on frozen concentrate orange juice. And everybody thought the crop was going to get destroyed. Not spoiler alert, sorry, 30-year-old movie. But everyone thought the crop was getting destroyed, and therefore the price of oranges or orange juice was going to skyrocket. So everyone was trying to lock in the price now, and as soon as it came out that wasn't true, price plummets, and all of those very, agreements to buy it at a very high price suddenly became worthless. Right? That's the premise. That movie is actually more complicated because they did the trade in reverse by selling first and then buying to cover. So that's beyond the scope of this particular talk. So the last kind of, let's call it bet or insurance or hedge on future price that I'll cover is an option. So options tend to be a little bit more accessible to your everyday investor. That being said, they're a bit more complicated. So an option is unlike a future or a forward. It kind of only revolves around one side of the movement. So you're usually betting on either the upside or the downside. So for example, if I'm purchasing a call option, which is let's say the flavor of option, not the type. A call option is a bet on the upside. So I pay some price to be able to buy a security, whatever that might be. In this case, most people think about it as stocks or equity. So it could honestly be anything, but it's the right to buy a security at a certain price in the future, which is known as the strike price. So, you take XYZ's equity is trading at $100 to make the math easier. I might buy a call option, which has value, might be $1 or $2. Let's call it, I pay $5 for the right to buy the stock at $110 6 months from now. So if that stock winds up any less than $100 or $110, the strike price, you're not going to make anything like that. That's called expiring out of the money, where it's in the money if it's at all above that price. And so what you'll notice is because the option itself has value, there's actually a little bit more of a hurdle. You have to actually make a little bit more than the cost to make the bet or buy the option itself. And that's why on these payoff diagrams, it's actually shifted slightly below the x-axis because of this extra hill you have to climb from a P&L perspective. So the real intention is, I can pay very little, and it's a very highly leveraged bet that the stock will, or the underlying will appreciate, and that I'll be able to cash in and say, oh, if it's $200, then as soon as that contract expires, and I'm assuming this is a European option, which we'll cover in a second, then I can immediately exercise those options, and I have the right to buy those shares at 110, and I can immediately turn around and sell it for $200. So that's a huge win. I get $90, right, immediately because of that. And so option pricing tends to be a bit complicated. It uses a model known as Black-Scholes, which we'll cover in a future talk. And the real driving factors here, which is the important part, are the price of the underlying, obviously, the strike price, which you care about. What's that future price that you want it to be above or below? The interest rate, which always comes into play whenever you have any kind of time dependence, and we'll talk about that later. the volatility, and the time itself, the time to maturity. So it's RSTK signal. So those are the things that affect the value of this. So if the stock becomes more volatile, starts moving around, your probability that it's above or below a certain value by definition will increase because it's moving more. As you push out that time further and further, kind of anything could happen, and the probability that it could be above or below that strike price also can kind of increase. One thing I didn't touch on, I've been talking about call options this whole time. So you could also think of a put option, which is probably used more frequently for hedging and insurance. So a put option is just the other direction. I want the right to be able to sell a security or an underlying at a specific future price. So in that case, you're kind of betting on the price to go down. So you could speculate and just hope, company XYZ runs out of money, goes bankrupt, in which case you win, hooray. Or more realistically, you are going to potentially buy a put option in conjunction with the underlying security. So it provides that protection. So let's say it costs $2.50. In that example, you spend that money almost like an insurance policy, such that if it does go below the strike price of the option, say $100, you're covered. You don't actually lose money. You lose money on the security, but you make money on the option. So it limits your upside by exactly the cost of the option, but it helps you sleep easier at night, or makes you a little bit more risk averse or conservative if that's your intention. So those are the ways, and obviously you can be on the other side. You can actually be issuing the options and being the one who has to basically pay whether you're in the money or out of the money on the other side, which is writing options tends to be a bit more risky. The profits or the losses can be unbounded. If the stock goes to $1,000 and someone bought for $2 the right to buy the upside, you're on the hook for all that. So it takes a different type of professional to be able to actually write the options. So we've been talking about options, assuming that we're only looking at that fixed date at the end. On the left, I've got a laundry list of some common, and common should probably be in quotes. Some are more common than others, but common types of options. So European just means that you can only exercise at maturity. American means you can exercise whenever, anytime throughout the life. If it's favorable, then you can say, you know what, let's close this out. Let's do this trade and settle up. I don't have the math in front of me, but I do recall a theorem that says that according to theory, you should always exercise an American option at maturity anyway. I'll see if I can dig up that proof. Bermudan's sort of the compromise. Bermudan says, well, instead of just at the end or any time, there's just specific dates. Let's say at the end of every quarter where you have the ability to exercise. And then things get a little bit more complicated. In financial parlance, we call those exotics. But some of the more interesting kinds of options include Asian options, where instead of a price at maturity, you kind of look at the average price over a period. So there's also barrier options, which only are valuable if the underlying price exceeds or falls below a barrier. And you can have double barriers if it goes above or goes below a certain threshold. There's basket options where it's more than one underlying. It's a whole basket of securities. Quantos, in which typically they're paid out in a different currency in which they were purchased. Warrants are hesitant to put them under options here, but they're kind of longer dated. Like if I wanted, options tend to not really go longer than, say, a year, give or take. So warrants are much longer term of the same kind of security. And then digital options were popular back in the day. I think there's been some crackdown on it, but those are just, instead of continuous payoffs, they're kind of just discrete bets. If this happens, I get $100, else I get $0. So those are some of the high level ways of investing in ways to hedge or bet on uncertainty around future price. So once again, I'm just going to take a pause and see. I'm covering a lot. Does anyone have any questions? Anything surfaced from the chat as of yet?
No, we don't have any questions from the Slack channel at this time. But it's I had heard these terms before, but I'm glad to have them explained and whatnot. So thank you.
Sure. So those are the ways of hedging on future price. Now we can talk about ways to hedge on sort of other types of macroeconomic uncertainty. So again, we're venturing now more into the realm of OTC securities, in which they're bespoke. There definitely is standardization among these types, but typically a lot of these are not listed on exchange. So a swap is an agreement to exchange value at one or more future periods of time. And I think it's usually more. So my explain like I'm five. The best way I can do that is, how about every n months, every 3 months, I give you X and you give me Y, and we'll make sure that when we initiate this deal, this agreement, that we're on equal footing, such that no one's winning as of today, and let's see where things go. That X and Y could be keyed off of any number of things. So I think the most common types of swaps tend to be interest rate swaps. So those are, let's look at what that interest rate is. And the interest rate is something that is typically either implied or set by the federal government that's in control of the money supply. And I mentioned earlier, there's a lot of types of debt securities that pay floating rates, which means, they pay a reference rate. You observe something else and either add to it or just pay that out. So the swap contract, the way I learned about it in my academic history, was it's a way to financial engineer. If you've issued one of those types of debt and you don't really want to be on the hook for making floating payments, you can enter into a swap contract in which you receive floating payments and you pay fixed payments, in which case you pay fixed, someone else is going to pay you floating, and you turn around and pay that to your obligations on the debt side. So that is a really great example of what's called financial engineering, which is packaging more than or designing and architecting different securities in conjunction with each other in order to accomplish a very specific need, such as that. So when it comes to interest rate swaps, you've got fixed and fixed to float. So in like that example, there's other types of basis swaps where you're looking at nuances within sort of the same curve, the 1 month rate versus or a curve derived from the 1 month rate versus 3 month rate. You can have both sides floating and just a giant lump sum payment at the end. Total return and equity swap, which kind of looks at the equity swaps, are really interesting. You're paying some fixed fee, let's say 5%. On the other side, we're going to pay you whatever the return of XYZ's equity is every quarter. So why would you want to do that? Well, first of all, it's a way of actually exposing yourself to the returns of an equity without actually having to outlay all the capital to buy it. And more importantly, when it comes with, or when you're issuing an equity swap, one use case would be if you have, let's say, an executive, let's say the CEO of XYZ childhood company has a lot of XYZ stock. Now, they can't just go and sell it, because what would that do? That would trigger panic in the market. Well, why is he selling? Does he, or she, why does she not have any faith in the future of the company? Should I sell my stock too? Well, no, maybe they just have way too much concentration, and the name of the game is diversification. You want to put all your eggs in one basket. So how do you sell without selling? Well, you engage in an equity swap. You pay the returns. You basically promise whatever the returns of the equity you own is to someone else, and in return you get some fixed or whatever the other side of the trade is. So therefore, you've mitigated and kind of nulled out the risk to your particular holdings without removing your ownership of them. So it's a very creative way of doing that. It's very common, actually. So just like equities, you can have swaps for commodities. Another very common type of swap is a foreign exchange swap. So same example, except that now we're trading one currency for another. I'll touch on this in a minute, but this is where you would lump in credit default swaps. So I'll explain what that means on the next slide. And then you can get a little bit more complicated. You can have variance and volatility swaps, where volatility is not necessarily a directly observed, like it's an implied variable. You look at whatever the standard deviation is of a market, let's say the S&P 500, the FTSE, and use that as the reference to one side of the payment. So if you wanted to protect yourself against volatility and just any very large erratic moves in the market, that's one way to do it. And combining our previous slide, There's also a investment vehicle known as a swaption, which is an option on a swap. So instead of delivering the underlying security, when that swap hits maturity, or the swaption hits maturity, you actually have the ability to enter into whatever the underlying swap is. So it kind of like starts in 6 months.
Hey, Rob, question for you.
Sure.
You say these are over the counter, which means they're not on an exchange.
Mm-hmm.
How do buyers and sellers of these types of swaps find each other?
So usually this is where you'll go, like you'll engage a financial institution. So this is what a number of departments at financial institutions will do. They will structure these deals for you. And so I mentioned earlier some of the problems with the 2008 crisis. What the banks, for example, will do is they'll say, oh, they'll get, let's say a hedge fund will come to them and say, okay, I want, a variance swap. I want some crazy, ridiculous type of security that pays every 3 months and blah, blah, blah. The bank will structure it. Corporate lawyers will get involved to dictate the terms. They'll put it on paper, and then they will go to the other side and find a buyer or seller. What happened in 10, 15 years ago is the bank decided, well, or sometimes they would say, well, we'll just keep the other side open. We'll take the other side of the trade, which in some cases it could work out, but the question is that I'm not qualified to answer is, are they, should they be taking on that risk? Is that the purpose of their business, or should they just be making commission on structuring the deals and moving on to the next deal, which is what you see much more today. So really, when it comes to structuring OTC securities, it's not usually something that an individual shy of like an ultra high net worth, someone with lots and lots of funds at their disposal would do. But that being said, you do encounter these at the institutional level. If you're working for a financial institution, you'll see all of these sort of on their balance sheet, on their book of business, to hedge risks, to transform securities, or what have you. So, in our world, in my world, in Kirby's world, these are things we have to model. Sometimes you'll see a balance sheet full of crazy, ridiculous stuff because it's done from a speculation point of view, but often it's tied up. Each desk, it's their insurance policy, their hedge against certain variables that they don't want to be exposed to. If I don't want to be exposed to volatility, if my mission is to be exposed to something else, let's say interest rate risk, I might want to hold my return with respect to volatility constant. So this is a way of kind of muting the profit and loss on something that you don't want. I mean, it's like insurance, right? If you don't want something bad to happen, you can pay a fixed payment, and in the event that something bad does occur, you get a payout. So moving on, that's ways of tackling sort of macroeconomic uncertainty. And I touched on credit default swaps. And your question was a brilliant lead into this. So let's say I go to the bank, I structured one of those securities, and a very nebulous company took the other side of the trade. So now, great, I'm paying a fixed payment every month, and if something happens, maybe if things move in my favor, they owe me a lot of money, which is the intention of investing. But what happens in the case where, because things go bad, they can't make good on the payments? I'm expecting that insurance and I don't get it. So that is known as credit risk, counterparty risk. It's the risk of an institution or an individual not making payments. So the credit default swap was invented as kind of an insurance policy on a counterparty or on an institution. So originally it was like, if you own a bond of a company, you might want to take out an insurance policy that if that company goes bankrupt, you get paid back because you're lower on the totem pole. You're at risk of losing all your investment. So in that case, you could buy a credit default swap, and it's very similar to our put option example earlier, where sure, I have to pay a little extra, but if things go wrong, whoever I've entered into this credit default swap with will provide me with insurance. And this is actually what happened in 2008 was credit default swaps were being used by people who did not have necessarily exposure to the things they were insuring. So I was actually taught that this is akin to buying car insurance on like your neighbor's car. So you can do it. It's just, would you want to? Does your mandate as an investor allow you to do so? And what really happened in '08, which we'll touch on in the next slide, is that provided a foundation for a whole family of securities that were built on top of that framework that was more and more leveraged. So, the use case, I think I touched on all three use cases here. And credit default swaps, they historically have been OTC, but in the last, I want to say 5-6 years, there has been a large push to standardize them. And I believe there is actually an exchange traded market for credit default swaps in which they're standardized. They have a fixed either 100 or 500 basis point payout or coupon rate. And I think it's been 4 or 5 years since I've been knee deep in this industry, but at the time there was about 700 liquid names that were very actively traded. And if you needed more bespoke insurance against like a counterparty of your crazy variant swap in our last example, or just something that didn't exist, then you'd have to go and create a sort of custom contract. So again, just you look at these payoff diagrams, it's just like your homeowner's insurance if you have such a policy.
It's all kind of bizarre to me because it feels like if I was going to take an insurance policy out on the other guy not paying out when he's supposed to, I just wouldn't trust him enough to do it, and I just wouldn't enter into the contract. I don't quite get it.
So there's three parties potentially involved. You are looking at XYZ's balance sheet, and you are speculating they're not going to make their payments, and so that whole liquidation process is going to occur, and I want to be able to profit off it. So I'm going to take out a bet that says, if they go bankrupt, you pay me out 90 cents on the dollar or whatever it is. I'm going to give you $100. I'm going to give you $5 a quarter. You're going to give me $100 if an event happens. And that event could be defined as a bankruptcy. It could be defined as a change in credit rating, that may or may not be a precursor to a bankruptcy or financial hardship. But the person that you buy that contract with is party C. It's not necessarily party B. Like party B can't give you money if they're bankrupt. Right. So you'd go to party C and say, hey, I bet you party B, XYZ company, is going to go broke. And they go, nah, I think they're going to be fine. You're on, so to speak. And they enter into a contract. You pay them $5 every quarter. And if they go bankrupt, they pay you $90, $100.
Right.
So it's going to be a winner and loser there. Potentially, if you've made enough payments, then potentially they don't mind paying you $100 because you've paid, multiple years of insurance and you've given them more over time, which is
right. Yeah, I can see that part. Yeah.
So, the credit default swap, it started as insurance. It very quickly became a way to speculate and bet on the financial health of bonds and other sort of institutions. And without further ado, here's where things got crazy. So I lumped a lot of different types of securities into this. Well, the way I think of it, they're packages, sometimes they're tranches, securitization. So let me unpack, quasi-intended, each one of these things. So, a package might be as simple as like an ETF for a mutual fund. So what is that? Those are, for all intents and purposes, they appear as stocks. You can buy them on an exchange. But they represent it's a portfolio of securities. It's not necessarily just one company. So what a mutual fund is when a company and a bunch of very talented portfolio managers who presumably know better about their respective markets than you do will assemble a collection or a portfolio, as it's known, of companies. And then they will offer you shares in that collection, and they presumably get some sort of fee, which pays the bills and allows them to do this good work for you. An ETF is very similar, except instead of a direct manager, or the way it's structured is that it's actually a standalone company. So you go back to our balance sheet example, there's no liabilities, there's no, it's just assets. So I have a company that does nothing but owns $100 billion of gold. And if I sell shares of that, then those shares represent sort of indirect ownership of gold. So it's one way to gain exposure. An ETF might also have, let's say the S&P 500. They'll buy one share of all of the 500 companies of the S&P 500, all 100 of the FTSE 100, whatever it might be, and then they sell shares of that so that you as an investor don't have to build that portfolio yourself, because transaction costs are a very real thing. You go to any brokerage, they're going to presume most of them will charge you some sort of premium for making a trade. So to make 500 trades is not only expensive, but also tedious and sort of time consuming. So what this does, it's a vehicle that allows you to invest in that package without having to do any of the work. So that's, I want to be clear, that's one type of package. What I really want to talk about are some of the securitization based packages. So there, instead of equities or like mutual funds, what came about in the, I would say, early to mid 80s was this idea of a collateralized debt obligation. So similar to that ETF I just described, they're going to take a package of, let's say, mortgages or credit card loans or auto loans or something that there's like a whole bunch of. Some of those are good, some of those are bad. Some people have good credit and never miss payments. Some people have bad credit. So again, diversification is the name of the game. When you mix them all together, you have this more balanced pool that isn't, you're mitigating what we talked about on the last slide, which is credit risk. You're not interested in the individual credit risk. You're looking at sort of the exposure to the health of the whole market, or at least that's how it started. So the collateralized mortgage obligation was a giant pool of mortgages. Let's say, it's 100 houses and they're well diversified. Some are from California, some are from, Maine, Florida, all four corners of the country. So in theory, they're well diversified. 2008 showed maybe not so much. But before we get into that, it's important to note that instead of direct ownership in the pool, what can be done is something known as tranching, which is, if you look at the diagram in the right, that's an example of something known as a waterfall. So that means it's just like the way when a company goes bankrupt, it has to make payments in a certain order. Different tranches or slices, which I think tranche actually means, are different tiers. So usually the top one is known as the most senior. It gets paid first. So maybe that's 60% of the total pool are senior tiers. They get paid if there's still money. When I say get paid, each of those mortgages, everyone makes their mortgage payment. There's some principal and interest. There's interest that is made. And since those mortgages are in this package, you have to transfer that profit to the owners of said package. So you're going to go through this waterfall and pay first to the senior tranche. If you then do what's called an over collateralization test, or you just check to see that the health of the basket is still good. And then you can pay out to the next tranche and the next tranche. And you can go all the way down to the bottom, which is usually known as the equity tranche, which is the most risky. The moment there is not enough payments, and that could come from either prepayment risk, when people pay too early and there's just not as much interest made off of them as expected, or default, they stopped making payments altogether and there's just less money to go around. Those bottom tranches are the ones to get hit first, which makes sense. That's why they're cheaper. They don't cost 99 cents on the dollar. They cost 10 cents on the dollar, 40 cents on the dollar, whatever it might be, because you're taking a giant gamble that there's going to be enough money left over to pay you and compensate you. But if there is, you get paid, orders of magnitude more than you put in, which is why you do the deal. So obviously there's a type of investor that's interested in that kind of, I guess I'll say it, gambling. But at the top, those things, because everything underneath it has to default before it gets touched and you lose any of the money you gave it, that's a much safer investment. And so this can be done using actual loans and debt. What became popular, though, is this exact same situation, the same framework, but using credit default swaps. So that's known as a synthetic CDO, where instead of having the actual underlying mortgages or bonds, you actually have a portfolio of CDSs, credit default swaps, in it. And it behaves in a pretty similar way. There is a family of trading in a market known as base correlation risk, which it's sort of the limits of my financial engineering understanding. But the way it works is it plays off different idiosyncrasies between different tranches in markets. So there's all sorts of neat things you can do. And so, beyond that, what happened in the crisis is you took all those equity tranches. As we said, they're very risky. They represent the highest probability of default in the portfolio because they're the ones that stop getting payouts first. what was done is something called a CDO squared, in which they took those risky slices from a large number of CDOs and recompiled them into yet another one. And because it was well diversified, it was, had less risk than any of the individual parts. So you could do that in theory as many times as you want, but you realize that you're building sort of a reverse pyramid where you have, it's like an upside down pyramid where it's just more and more unshaky, built on the same sort of foundation. So again,
yeah, House of Cards comes to mind. The term House of Cards comes to mind.
Let me be clear, there's nothing wrong with these securities. The only issue, and the thing that people will talk about, is the types of people who are investing, structuring, and using them. That's where the conversation really needs to happen. You can make whatever bets you want. Like I always like to say, if you're an endowment, like, you're beholden to no one except the future students and staff of your university or whatever. You can invest in anything you want, right? If you lose money, you don't, lose the pensions of your, an entire nation's teachers or something, right? Like it's kind of same with hedge funds. Hedge funds are by design, they fill a space where they can invest and play in markets that, maybe banks and more classical asset managers don't have the risk tolerance to, because they have just a different calling. Like, it's just not their business model. So there's nothing wrong with the securities themselves. It's really when they get used improperly that we have a problem. So just to wrap things up, because I know we're coming to the top of the hour, combining what we've learned, all of those different flavors from forwards to futures, those can be applied to any of those original foundational securities we talked to. So here are some popular markets. Obviously, the first futures market that comes to mind is commodities futures, energy, agricultural, precious metals, cryptocurrency, you name it. But there's also bond futures, where you can, buy a bond, or what's known as cheapest to deliver in a package of bonds, or a list of bonds at some future date. You can buy an equity future. I want to buy XYZ stock, 6 months from now, and we'll shake hands and decide what the price is going to be. Interest rate futures, which are, bets on whatever the actual interest rate of a sovereign nation is going to be, and FX futures on currencies. We talked about the securitization in index markets, mutual funds, ETFs, hedge funds. A fund of fund is purely just a fund of hedge funds, so you're not at risk at any particular hedge funds. You're diversifying across hedge funds. There's mortgages. They tend to get packaged into RMBS, which is residential mortgage-backed security, CMBS, commercial. They're effectively the same security. There's just different nuances and not standards, but defaults, I guess. That's a bad word too, has double meaning. But there's different protocols in different markets that people think about RMBS one way, CMBS another, even though on paper, mathematically, they wind up being valued the same way most of the time. Same with loans. You can have a collateralized loan obligation where the loans just are company loans instead of like mortgage-backed or residential-backed. And we talked about CDO and then the synthetic credit. And you can have an option on almost anything. Right? Anything that you can trade, you can put an option, and we discussed all of the different dimensions that an option could have, whether it's a call, a put, whether you're writing it or buying it, whether it's digital or quanto, all of those apply. And I guess the other thing I'll point out here is, there is a such thing as, credit default swaption, or a CDS option, which is an option on a credit default swap. But you start to see they're all like, Lego pieces in your financial engineering toolbox that you can stack and build out any way you want to accomplish whatever need you're trying to hit. So that being said, we'll figure out a way to do a poll, whether we put it in the comments or send an email out or something. But these are some of the craziest stuff that I've seen in the market personally. So when it comes to assets, I once had to value a three-legged swap, a CDO cubed, a non-divisible $40 billion correlation book, going back to that correlation trading example we talked about earlier, and once was approached to help construct a collateralized patent obligation, which was particularly interesting. And I've definitely seen some hedge funds with some really interesting day trading of CDS options, something known as J-risk, or distressed debt trading, which the head trader at the fund I was working with described as Well, all of the risk is whatever the judge decides the day of liquidation. So they buy, debt. Like once an asset manager can't own a security anymore, uh, they have to offload it usually in a hurry. These hedge funds can scoop it up at a huge discount, and then they just have to hope that when they start liquidating the assets and paying back the investors, that they make more than they paid for it. So that the J risk is judge risk of literally the individual that's making the decision. And base correlation spread trading was very popular. I don't know if it still is, but there was a number of very large firms engaging in this, at least 3-4 years ago. And it's just a market taking advantage of spreads between some of these securities that most people don't know exist. So it looks like we're
So Rob, the way we'll do this is we will ask people to leave a comment on the YouTube page indicating which of those that they would like to see you address.
Sure.
We will put in the description the basically a recap of that slide so
Great.
People can see them again.
So I think we ran out of time because I want to keep this to an hour to talk about time value of money, but that's okay. What we'll do is we'll use the results of whatever you guys want to talk about. We'll leave that to the end of the next session to we'll walk through how to value or how to price one of those crazy securities if there's interest.
No, I think there's definitely interest in talking about the time value of money because we hear that so often. I think we'll give people a couple of seconds to submit questions if they want. And while we're waiting, I would just like to, I don't know, pose almost a rhetorical question to you. This has been very interesting to understand about all these types of deals and contracts that can be entered into. And I can't help but, recall so many people who have told me that, our financial system is so digitized, it's all just ones and zeros. Nobody's even trading pieces of paper around anymore. And so I'm curious, that says to me there has to be, for lack of a better word, data models for all of these types of contracts. And so will you be covering some of that in the future? And like, what does this look like? What all these deals look like in software, and do different companies write code different ways to represent these, or is there a standardization of how to represent all of these types of contracts in software?
Great question. So yes, the intention of the next talk would be covered just that, is the different types of financial models. How do you price each of the things we talked about based on their properties? And price might mean now, like mark to market, what's it worth? If I were to get a quote,
Right.
or is he ripping me off, or is that a good deal? And more importantly, from where like a risk manager or an investment manager would care is, what's this going to be worth in the future, which is a very difficult question to answer, because anytime you're dealing with future, as we've covered, there's dramatic amounts of uncertainty. So one thing I'll mention is that what my team and the IBM Watson Financial Services team is striving to do is to make accessing all of this, the data required to populate these models, the models themselves, and then workflows on top of them. We're trying to make them very easy to use. So, as I mentioned, we have a series, and I'm showing them on the screen now if we can still see it, but we have in the experimental catalog of the IBM Cloud, there's actually a number of services there today, and you guys can try them out. And what we can share with you now is that in the next, let's say, couple of months, we're going to be releasing brand spanking new versions of some of this stuff. And one of the things that will be coming out is a data component that will power all of these applications. So, while it's nice to know everything that I just covered, we don't expect you to be an expert in all of this. Most people aren't. They get very specialized in, one market, one type of security, one field.
Right, exactly.
We are providing a service that will sit behind the other service, and we'll cover that in a future talk. But it will allow all of the data, all of the inputs, historical and present data, current data, to populate those models in a seamless way. So obviously, by us doing that, we have a standard. To answer the second half of your question, that yes and yes, there is a standard that has kind of evolved based on the maturity of each market. So for some of the more bespoke CDS credit kind of securities we talked about at the end. It's a little less mature, but there's still a well-established model. Whereas, equity modeling and debt modeling have been around for quite some time. But that being said, there's no right answer, right? It depends on what your particular use case is, what your firm's protocol is. So, we've been in the business of risk management for, I want to say 30 something years here at IBM, Risk Analytics, formerly Algorithmics. So, we know a number of standards, and we're going to be providing that standard kind of the way so the user doesn't need to specify any additional information if they don't want to. But obviously the framework is there to allow people to specify their own inputs, parameters, configurations, etc. So
Okay.
that
Fair
is,
enough.
and I kind of ran out of time to show examples. We'll show them the next time, but hopefully we can cover some of the use cases behind the data that populates all of the asset types that we were talking about when we do cover all of the asset types that I are included in this presentation.
Okay.
And then,
So I think that's a good note to end on. I'll just mention to everybody that if you would like to be notified when we schedule these future episodes of our FinTech series, you need to be signed up to the developer webcast calendar. And the way you do that is you go to the event page. So if you're watching on YouTube now, go to the description field. The first link in that description field will take you to the event page over on IBM Developer. On the event page at IBM Developer, there is a link to subscribe to the Developer Webcast Calendar, which is a newsletter, email newsletter. It comes out just once a week, and it will show you all of the webcasts that we have scheduled coming up over the next couple of months. So by subscribing to that newsletter, you will be able to see when we schedule new webcasts in our FinTech series. So Rob, thanks a lot for getting us launched on this today. There's been so many interesting concepts that I have learned. I've heard these words before and never quite knew what they meant. So this is a good launching point for the series. Thanks for doing this for us today.
thanks for having me.
All right, bye-bye now.